Alrighty, welcome everyone to this episode of the Wealth and Wisdom Live podcast. Today's gonna be a little bit different. First off, I want to apologize for being gone for so long. I feel like it's been forever since I've actually had my face on this podcast. Excuse me. I've been feeling very sick and I've had some stuff happen in my life recently that has changed in a big way. It's changed how I'm thinking. It's changed how we're going to move forward with wealth and wisdom. And so we're going to be talking about that. I'm pulling back the curtain a little bit for everyone. In this episode, we're going to be talking about ending the BDIC partnership and what's next for me, next for the show, and for all of you. So without getting too deep into it, let's get started. What you can expect from this is we're going to be talking about BDIC. We're going to give you an update on that. We're going to be talking about Iran just a little bit today. We're going to be talking about mindset and some practical systems for helping that when it comes to how you think about your wealth and what's moving forward for the show. And a special thing at the end, stay tuned. Also want to open it with, this is not investment advice. I am not your RIA. I am not an investment advisor. Investment carries risk, like with anything. So always speak to a financial professional. However, what I am do is I'm just one guy that's trying to build real wealth with you in public and help other people learn some of the lessons I've learned over the past 2 years that I've been doing this. Anyway, let's get started. BDIC partnership. Let's talk about this a little bit. For people who don't know, for the past 7 months, I've been doing a paid partnership with a company called Blockchain Deposit Insurance Company. I started because I believed in the company, and in fact, I still do. I stopped a workout in the middle of the gym when their white paper came out to read it. Um, I was compensated for that in the tokens that they offered me. And that matters because, as you might have seen with some of these articles that I've written for them, if you've read to the end, there's a long anti-touting and regulatory disclaimer that I've had to put at the bottom of each and every one. What I've been trying to do here with this is I was trying to promote the company because I believed in their mission. I was also trying to educate people on something that I believe is really missing from the crypto industry, which is the infrastructure to support risk management. It's not really there. However, as I got towards the end of this partnership, about last month, I was looking forward because I was updating all the disclosures. As it turns out, it wasn't strict enough. I've tried my best not to make the articles sound like advertising. They were paid advertising for them, but I wasn't trying to tell people go and spend all your money on BDIC coins. And I realized my disclosures weren't robust enough. So while I was sitting there one day learning about anti-touting, which is a part of the SEC's requirements for this kind of work, learning about regulatory disclaimers, learning about the laws around how news and how articles have to work, that fine line that they're working through, I realized two very big things. And another thing I'm talking about the end is also connected to this. One, I didn't want to do it anymore. It was nothing against the company. I truly do believe in their mission. I hope I've made that very clear of everything I've done here. But as I was reworking all of my disclaimers and going through every article and figuring out, okay, is this good? Is this bad? What do I have to do here? It wasn't fun anymore. And it wasn't really what I wanted to do. Didn't want to write articles for companies forever. I thought about that when I was working with BDAC. I'm like, oh, this is great. We could monetize the newsletter and the channel this way. We could just run specials for other companies. And it felt draining. I felt like I lost what the newsletter was originally about, which was helping to empower people. I believe insurance is empowering, especially when it comes to crypto. It's a new industry. So having someone like BDIC who's willing to do that is amazing. And hopefully they go on to do amazing things. But I officially ended my partnership with them in February. I learned some very powerful lessons here. First off, I need to be much more clear about what I write and the tones that I take with it, because I feel like when I was feeding some of my articles through AI, asking them if it was compliant enough, that it wasn't super clear that they were paid advertising. And so I had to go back and rewrite some of them, rework some of them. And it also taught me what I'm going to do different with sponsors in the future. Um, Here is my thinking moving forward with this channel, because I am open to sponsorships both on the podcast itself and in the articles. I believe that it's a great way to monetize any newsletter, especially on Substack. It gets you out of the rat race of trying to keep patrons happy and subscribers happy. Not saying that we're trying to still entertain everyone, but it gives an alternative money source. But here's what I'm thinking, and I'll probably finalize this in an article and post it on the channel, because then in the future, whenever someone comes in and wants to do a sponsorship deal with us, wants to do a partnership, I've got very clear guidelines. The first one is value to you guys, the listeners, the readers, the people who are actually compelling me to do this in a weird way. Obviously, just so you know, I didn't start this for you. I started this because I wanted to write. It was a creative outlet. But the comments people have left me on some of these articles and how inspiring they felt they were, the content that they liked, it really changed how I look at this. And so value is definitely the most important thing. People who are watching these podcasts, who are reading through my articles, if there's an advertiser, it's going to be for you guys. I'm going to be far more transparent about the sponsorship part and let everyone know, hey, this is someone who's paying me. I personally, just to be 100% transparent, I made a commitment to myself years ago that I'm never going to work with brands I don't trust, which is it was true for BDIC as well. Um, and that is going to be a big deal moving forward. If it's a paid sponsorship, you will know as you're reading through my work. But also understand that it's something I believe in. I'm not going to pitch random stocks to you guys. I'm not going to pitch random products to you guys. In fact, there's a lot of products out recently that I've seen on advertising, especially on financial influencer shows like mine, that I actually don't trust in 100% transparency. There's a really good video by the Plain Bagel who talks about stock shilling on YouTube in the finfluencer space specifically. Almost all of them have high betas. They aren't great investment vehicles. They're way too volatile. They don't make money. So I won't be doing that. You know, if I'm ever running a product for you guys on this channel, you will know the benefits, you will know the good or the bad, and my opinion about them. Um, Also, there's no pressure in any of this. Hopefully, it didn't seem like there was pressure with any of the BDIC articles, because I am firmly against that. I worked in sales at the first part of my career. I have no problem selling to people. But what I could never do and what I will never do is sell people crap. And again, none of this is at BDIC, so please don't clip this and send it to him to cause some kind of a fire war here. But I had coworkers and managers at, specifically, I was selling Massage Envy memberships. Weird that I transferred to this, but I had managers that would really do high pressure sale tactics. They would promise the moon and then leave their clients out to dry. I was never about that. I mean, we just talked about it as well in the article on life insurance. I walked away from one of the largest financial advisory institutions in the United States who were offering me a job. They were offering to train me, they were offering to pay for my licenses. Because when I dug into it, they were selling people life insurance and annuities, and in my mind, I don't think that's the starting point for everybody. And I don't think it's fair to friends, family members, to associates if you're just trying to shove products down their throat. It has to start with, again, with you guys. It has to start with the client. It has to start with the listener. It has to start with what they care about. And pardon my French, what they give a shit about buying. You know, your dollar is far too valuable to be wasting on a bunch of nonsense. And I should know I fell into a lot of traps of buying things that I didn't want or need. Anyway, um, going forward, sponsorships are going to be much more clear. I've learned a lot with BDIC. It wasn't all bad. I learned a lot about crypto. I learned a lot about crypto regulation. I learned a lot about what it's like working in a fast-paced startup. I mean, I never thought that I would say that because Beyond Abundance that I've been building for the last couple of years is fast. It's fast-paced, it's hard work. It's doing stuff on Saturday nights and working till 9 PM sometimes. Um, BDIC was faster for sure. Jeff, who will come on some of these episodes in the future, I'm sure, even if it's just in a viewer capacity. By the way, TalkSec, I did see you. Thank you for joining. Welcome to the show. Um, if you have questions, please leave them in the comments and I'll try to answer them. BDIC was fast paced, but I learned a lot. And those lessons are going to be used moving forward in this newsletter and in this show. I also learned an awful lot about how punishing the crypto ecosystem can be. And it's changed my view on crypto a lot. Which maybe we'll get into moving forward. We're not going to talk about that now. Anyway, let's move on to the next topic here really quick. We're talking Iran, we're talking geopolitics, and we're talking your money. Now, I want to make it clear really quick. I'm not a geopolitical analyst. I do a lot of geopolitical work sometimes on this newsletter because I find it very fascinating, especially when it comes to China. But I'm not an analyst, so obviously do your own homework, come to your own conclusions. Hopefully, what I have to say today gives you guys some value and helps you understand what's happening. So, I believe it was last weekend, the United States and Israel launched a series of airstrikes on Iran. This did not happen out of the blue. For people who haven't been watching it as closely as I have, for months now, Iran has been rife with large scale protests, public executions, and chaos. And that's already on top of the years of economic turmoil that they've been going through serious deflation, lack of jobs, and lack of a real functioning economy at all. The reason why, as far as I can tell, that these strikes occurred was really twofold. Three, depending on who you're listening to. First one was Iran, despite not being able to feed their people or provide them with clean water, has spent hundreds of millions and billions of dollars building out nuclear enrichment facilities for nuclear weapons. I know that doesn't come across very clearly to when you read a lot of like news articles about it. These massive underground complexes and centrifuges that they've tried to build over and over again for the past couple decades. You use them for weapons grade uranium. That's what they're used for. It's not for civilian reactors. I have that on very good authority. I had a brother who spent all of his undergrad doing nuclear research, or a large portion of it. What they were doing was weapons grade. They were trying to build specifically nuclear armed ballistic missiles. And we've tried several times with Iran to stop them from doing that, to join what's called the nuclear proliferation. Thank you. That's it. Nuclear proliferation treaties that prevent countries from making nukes.
Because, as you might have guessed, after the Cold War, you shoot one and everybody dies because everyone is armed. So the United States, and the other major powers specifically, have tried very, very hard to prevent that from happening. Iran hasn't wanted to play ball, especially since the Islamic Republic took Iran over from the Shah. They have spent pretty much their entire regime trying to build nuclear weapons. In the past couple of years, specifically with the first Trump administration and now the second one, the doubling down on tariffs and sanctions around that has caused Iran's economy to grind to a halt. If you ever listen to Business Insider, is a really good channel that talks about this. There's some other ones as well. A History of Everything is another really good source about this, I think. You hear just how much horror there is actually going on there. But even at just the basic level, a lot of their staples, gasoline, consumer products are being run through black market operations now because it's impossible to get them. They have multiple different interest rate regimes in that country, including some no one knows about that's only used for IRGC and government members. And overall, it's just not been good. So, after a series of failed talks with President Trump this time around, and also with the Ayatollah and his IRGC leaders continuing to execute protesters en masse. I almost said rioters, but it's protesters en masse, hanging them, not offering trials. Trump was getting fed up. From what I've seen, and I could be wrong here, Ayatollah doubled down and the IRGC doubled down on this after Trump said, hey, you need to stop or there's going to be problems. I saw videos of Islamic Republic councils and not councils, but Islamic Republic government meetings where they were chanting death to America and death to Israel. The US clearly had enough. And so I don't remember the exact date, but I think it was about a week ago. Trump and the US government sent a large flotilla of military ships and planes to Iran and performed a series of airstrikes early in the morning, basically taking out most of Iran's leadership off rip. They're not all gone. There's still a council of experts that is trying to find someone to replace the Ayatollah who was reported as being killed during the airstrikes. But it's only gotten worse from there. I believe it was early this last week where we started to see stories of drone strikes, Shahed drones specifically, and Riyadh missile strikes on areas like Qatar, Oman, Saudi Arabia, Cyprus, people around Iran. Not only that, we started to hear from splinter cell groups and hostile militias that are funded and supported by the Iranian regime, talking about wanting to kill Americans and Westerners all around the world. And specifically groups like the Houthis and others shutting down the Strait of Hormuz, where a large portion, I think it's 40% of all oil traffic goes. They were threatening to shut that down as well. As far as I can understand, and again, I'm kind of hazy on the details, sometime after the 11-day war, the Iranian regime decided that if the US and Israel were to attack again, excuse me, Iran would indiscriminately attack people surrounding them, other countries, oil infrastructure. I was reading an article this morning that called it a mosaic strategy, where basically the idea was if the Islamic Republic's leadership gets killed or cut off, then the IRGC leaders basically have free reign to attack whatever they want. There's not really a leadership command strategically picking these targets. It is just IRGC groups attacking targets around the Middle East. As you might have guessed, this has been quite a shock to a lot of the world. Brent crude right now is pushing about, I believe it was $80 a barrel last time I checked. We'll just double check really quick. Right now, people in Asia, countries in Asia specifically, and traders in Asia are pushing both actual crude prices and crude futures through the ceiling as they panic buy as much oil as they can get their hands on. It's even higher now. Brent is currently at $92 per barrel. And if we look at WTI crude prices, just to compare the two, because WTI is what's coming out of West Texas, WTI crude sitting at about $90. It's a 12% change. So the reason for why that's happening is, like I said, the Islamic Republic has decided that they are going to indiscriminately attack oil infrastructure to pressure America and Israel into backing off, as far as I can tell. And that has a lot of people panicked. See, unlike the US that only gets about 5% of their oil from there now, I think that's what it was last time I checked. We produce most of our own oil. The EU, the UK, China, South Korea, Taiwan, Japan, all of them depend on the oil that comes through that channel. And so what Iran is basically saying is if the US and Israel does not back off, we're going to sink the entire global economy. Jeff Snyder did a fantastic video piece on this yesterday that I was listening to, where he talked about the pattern that we see between oil shocks over global history and recessions. It happens pretty frequently. A lot of what I read right now about it has to do with that concern. Even I saw Nick Crown the other day was doing a little YouTube video talking about how much economic pain is going to be caused if this war drags on for a long period of time. So that's where we are. This could not have come at a worse time economically. On top of this, we've talked about this before, we have continuing problems in the private credit space. BlackRock just had one of their largest retail private credit funds hit, I believe it was 7% redemptions for the quarter when their hard limit is 5%. We've had another case of fraud in private credit that we'll be talking about later, probably next week on the newsletter. So we have that happening. And on top of that, from the way that I'm reading the tape, lenders specifically and investors are less excited and way more nervous about the AI trade narrative that's been happening. There's a lot to go into about that. We'll cover everything, but you have cases like Block firing 40% of their workforce on the surface, supposedly because they see AI is taking all those jobs over. When you look at their financials, it's a very different story, but we're in kind of a rut right now. To be honest, we have oil going up. We have gold and silver continuing to rise because of geopolitical and monetary risk. We have equities basically divorced from the actual economy. We're losing jobs every month as the tapes come out. It looks like people are seriously considering risk off behavior at large scale. Risk off is simply selling equities, selling the riskier assets. That's going to be your tech stocks. That's going to be your crypto. That's going to be your options, etc. And moving to safer things, gold, silver, bonds, etc. That's what we're seeing here, except for at the top. It seems like the top part of the K-shaped economy that people have been talking about, where you have this large group of people who are losing their jobs at the bottom and a very small group of investors at the top who are doing really well. They seem to be doubling down on AI and doubling down on this asset bubble, which is very concerning. Let's break away from the doom and gloom for a second, I want to cover just a couple of questions. Um, Before I talk about kind of my overall position here. And I think these are questions that everyone should be asking, whether you are just a hobby investor, whether you're a business owner, or just an average person trying to save their way and invest their way to wealth. Um, and the first one is, do these headlines truly change the cash flows from the businesses I own for the business investor or the business owner, businesses I invest in for the investor, or businesses I work for the employee? I think that's an important question we need to be asking. I know for me personally, the startup I'm working for is privately funded, so I'm less concerned about my job specifically. I'm very concerned as we're moving forward trying to build cash flow, but I'm less concerned about that. Um, if you are in a situation, regardless of where you are, you should be asking that question. Moving forward, what does this mean for my employment? What does it mean for my investments? And just give that some thought. Me personally, again, this is not financial advice. I have a lot of cash sitting on the sidelines right now for my investment account, which we'll talk about in a second. Um, I'm also being even more picky about the stocks that I pick, um, and the companies I choose to invest in. Second, is this a shock or a structural shift? Personally, I think it's a shock. I don't see any more major structural cracks than we already have. Does that mean that this is just going to blow away and that no damage is going to be done? No. Damage will be done at the very least for the next couple weeks. And depending on how long this drags on, we could get some bigger repercussions in things like private credit, stocks, equities, etc. Um, this last question is the most important one. For me personally, it's one that's got me in trouble more often than not. And I think it's something that every investor and every person who's trying to grow their wealth should be thinking about. Am I reacting emotionally to this? Or am I following a preset, well thought out logical process? Um, One thing I learned when I was in my undergrad, and I learned this both from my fellow students, I learned it from real Wall Street professionals who were former students who came back to say hello. I learned it from my professors who were former Wall Street professionals. Wall Street does not invest based on emotion. They invest based on models. They had a whole staff of analysts and statisticians who get together and determine based on factors that they see and assumptions they make what they should be doing with their capital. And that matters for the retail investor because unfortunately, both in my experience and from what I've seen in the markets in general, we as retail investors are reacting emotionally. We're not following these processes that are set up. Some people are, but for the large part, we react. And what I can pretty much guarantee is if you are reacting to headlines at this time, buying sudden dips and selling sudden drops, it's going to cost you. When it comes to investing, when it comes to building businesses, when it comes to doing really anything, the last thing you want to do is react because reaction gets you in trouble. Instead, what I suggest, and this is something I've been trying to do for several years, I haven't quite perfected it yet. In fact, I'm going back to the drawing board with some of it a little bit, is to create a model for how you are going to run your business, how you are going to run your job, how you are going to run your investments, and how you're going to run your life. Pick a moment in time when you are not feeling emotional and build a model for how you're going to do those things. If you do that, it will help you through the chaos that we're continuing to see. Here's a little bit of extra advice that we're going to get into. But first off, my opinion overall is right now I'm in the camp that this is going to end quicker rather than longer. However, damage is really going to be done. What I don't know, and this is the only thing that keeps me up when I think about it, is how many missiles Iran has versus how much infrastructure we have to stop those missiles. If, like some news I've said is true, where Iran is really short on ammunition, this will be over quick. It'll be over in a couple weeks, and the pieces will fall where they lie. I think the US being involved in this is a bad idea. We were in the Middle East for decades. It was painful, it was expensive, and it was messy to get out of, and we're going right back in. I understand, or at least I think I understand, the US government's response and why they chose to do this, but I think it's a bad move. Anyway, let's get away from the doom and gloom again. Here's some advice for investors specifically. Don't YOLO trade. I could probably just stop it there. Do not trade because you're worried that you missed the rally, or sell because you're worried you're going to get caught with a falling knife. Do your homework. Read through the financials, read through the news on the company, get an idea together of how you're going to trade if you're a trader, or invest if you're an investor moving through this. And let's also talk where your geopolitical risk should actually belong when it comes to your portfolio. Again, this is not personal investment advice, but this is something I am personally doing moving forward. Um, I'm thinking a lot about where my positions are, what companies I choose to invest in, and where they are. Also, sectors. I try not to double down on one. Like, I'm not like a couple of my buddies. I had some friends in college who acted like they were investment professionals when all they did was sell options on, or buy options on Nvidia. I don't think it's a smart move. If you're not doing the ETF buy at a dollar cost average strategy, think about where you're putting your money. Ask yourself some questions about whether you should be putting some in bonds, in metals, um, in other instruments aside from stocks. Also, consider moving your sectors. Um, if oil prices stay high for a long period of time, I could see consumer staples, I could see manufacturing and other areas being affected and not performing very well. On the other hand, like I've said previously on this channel, energy is probably going to do very well. One of the big, I would say, large scale takeaways we can pull from everything that's happened in 2025 and 2026 is, excuse me, that energy is an issue all countries are facing, and it's something they need to fix now, and they don't have the resources for. If they play their cards right, I believe many Western countries are going to double and triple down on their electrical infrastructure and their energy infrastructure over the next decade and seriously build that out, which means there's going to be serious money to be made there. And I'm not the only one saying that. I think it was Euro Capital, I noticed right before we came and did this live, was also talking about that, saying that every country needs to be worried about that. That's something that you need to be considering. And we've talked about this already, but there's actually a factor that's far more important than what you choose to invest in. And it's actually one of the reasons I started this newsletter, and that is your mindset and your behavior. This next section, I personally believe, is far more important than any headline you will read this week or anything that I write. Let's jump into that, shall we? Wealth isn't the money. Wealth isn't built in the money you don't see. It's built in the stuff that you choose to buy. That's a little esoteric, but let's walk through it. What is wealth? And what is money? I think first and foremost, people get weird about their money. I know I do, a lot of people do. What money is it's simply a piece of paper or information that represents the value of your time at a very basic level. It's used to value what something is worth to another person. When we say that a iPhone, for example, is worth $1,000 and we make $25 an hour, or better, we'll make it even easier. Let's say we make $100 an hour and we're looking to buy an iPhone. The iPhone's $1,000. What you're saying by buying that iPhone is that you believe this piece of technology is worth, what is that, 10 hours of your time. However, people don't always look at it that way. A lot of people, both investing and in real life, aren't really using their dollars and in turn their time in the most optimal way. You think of the people buying Gucci bags and Carhartt sweaters and buying cars that they couldn't afford after COVID, but it even goes a little bit further than that. Look at all the people right now taking lottery ticket risks in investing. I remember when I first got on Twitter last year, that I've since stopped now. The two craziest things I've ever seen in my 2.5, almost 3 years of learning about finance, the craziest things I have ever seen. One of them was a person showed a picture of their portfolio and they basically said, I don't buy any stocks, I just buy options. And the other one was all the people touting their crypto and their crypto portfolio and how well that was doing. When we got our first downturn at the end of last year, it became very, very clear who was actually smart about their investing journey and who was taking major gambles with insane levels of leverage on speculative products. Crypto community, please don't come for me. At its current iteration, every single coin that I have looked at and that I've analyzed behaves like a speculative investment. We're going to be digging into that more, including on Bitcoin, which I know is going to get me into a lot of trouble with a lot of people. But Bitcoin behaves far more like a high beta tech stock than it does like an alternative to the fiat system. And when you add to the fact that many people in 2025 and before were using 2x, 3x, 3 or 4, 5 or 10, or sometimes 500 times leverage on their positions in crypto, you realize it was a casino, not an investment platform. Sucks to say that, especially someone who believes in the future of crypto, but it's true. Many of us say on one side that we want to be wealthy, that we want to be good with our money, that we want to do things like save for a house and save for retirement, especially in the trader and influencer space. But then we turn right around and we throw it all on the roulette board. I made those same mistakes when I first started school, and it cost me dearly. So, what I did, and this is what I suggest that everyone does when it comes to risk, is I set rules and I set limitations on myself of what I could and could not do. First off, my trading account, I call my fun money account. I have a small portion every month that goes into an ETF that tracks the S&P 500. That stuff doesn't get sold. The rest of the money that goes in there, I assume is already gone. And that's the money that I use to trade. I don't use the money that goes into that ETF to trade random stocks in crypto. And I have hard stop losses that are my rule that prevent me from taking on too much risk per trade that I deem as safe. So I'm going to share a story with you guys that actually highlights this. We're going to be talking about 2 wins and 2 mistakes today. I'm going to start with the mistakes to give you a really good idea of what's going on here. At the end of 2025, about September, October, I was doing really well. I was beating the market on my fun money account. And I was like, this is great. I made all this money on these stocks. It's fantastic. I made some money on crypto. I was just holding it there in free cash. I'd put it all into gold. It was doing fantastic. I had sold all of my stocks before the first drop because I was listening to some analysts, specifically, I don't remember his name, Chris Whalen, who said that it was time to take your chips off the table, start taking some gains back. And that's what I did. I was feeling good. I was feeling cocky. And I was like, you know what? Let's sell the gold. Let's sell the silver. I kept those gains. It was perfect. And I threw a bunch of it into crypto. Because in my mind, I was like, this is going places in this world. I really do believe that, even now, even after this happened. A few whales sold off. All of these insanely leveraged positions were called, and I lost 35% on my Bitcoin position before I sold. My Solana one is down 45%. I haven't sold that one, so I'm just leaving it as a paper loss. I'm just going to let it stay there. We'll see if I choose to close it moving forward. That was painful. That was very, very painful. And it's because I ended up in that position because I stopped thinking and just started acting. You know, I saw a really good post the other day that said, I didn't know a lot about risk management until I made a mistake I could have avoided. And that was definitely one of those moments. The other one, the other mistake was what I harp on other people for doing. And it's actually what taught me this painful lesson is not doing my due diligence enough. Middle of last year, again, I was feeling cocky. I was feeling good. I had read the Trump trade Liberation Day tariffs issue like a book. I had made quite a bit of money, quite a good percentage off of that. And I was wondering what to invest in next, what to buy next. And I went for United Healthcare. In my mind, I was like, this is a good trade. It's got stable growth. It where you have an aging society that's going to need more healthcare moving forward. Issues like cancer, age-related illnesses are all on the rise. This is good. This is a good choice. I bought it at the peak before the CEO was assassinated, and then watched in horror as I lost probably another 15 or 20% on that sell. Thankfully, my gold gains allowed me to offset those, so I wasn't too badly off later on in the year. But if I had read the news, I would have known, for example, that the government was thinking about cutting back on subsidies given to Medicaid and Medicare. And I also would have seen that their revenue was dropping. None of us could have planned for the assassination attempt, but I could have saved myself a lot of pain if I had known that. Now let's talk about the two wins. This gets back to being unemotional, being unreactive. The first one has to do with crypto because I want people to know that you can be in crypto and be logical at the same time. You don't have to buy every moonshot post that happens. When I first started doing financial analysis in earnest, and this was back early 2024, um, I had come to the realization that something funny was happening in the crypto markets. Whenever Bitcoin would move, everything else would move with it, up or down. There are some rare exceptions, but for 90%, and even 95% of the coins, they moved in tandem. And so I tested it. I bought a whole bunch of an extremely cheap meme coin. And when Bitcoin rose, I made a really healthy percentage on that. I think I doubled my money. That was the first one. Big lesson there is I did my homework. I was curious, I observed, and I came up with a decision on what I was going to buy. It wasn't an emotional decision. I wasn't like, I'm going all in on Bitcoin. I bought a little bit and I made money on it. The next one has to do actually with Twitter. I bought Twitter 2023, I think. I don't remember. I was looking at it before Elon Musk decided to buy it. And I was actually looking at it because the acquisition was going on. The stock was not doing very well. It was fairly, I believed, underperforming the value that it offered. And so I bought some. And I waited. I waited through all of the nonsense and the conflict that was happening with the acquisition. I waited through the what was it, the court case and the lawsuit that happened on that. And I made out like a bandit. Again, not a decision about what you should invest in. The whole point with that is in both of those cases, in fact, I'll even toss in a third one, which I've talked about before. Vivo Power was another company I looked at. And specifically, my entire thesis was they're about to do a major stock buyback that's going to raise the price. I'll be able to make a couple bucks and I'll be able to move on. Did much better than that due to a black swan event I didn't know about. But the point on all three of those is very, very simple. Every case that I failed and I lost hard was because I was reacting, not thinking. And in every case that I did well, it's because I had a stable process and model that I was following for that particular buy. And I had a strong case to defend why I made that decision. I love doing this kind of stuff. It lets me use my brain, it lets me make money, and it's actually something that sits in this newsletter and something I love doing one-on-one, which is untangling the psychology that sits behind why people buy what they buy and why people do what they do with their money. It's actually the reason I started this newsletter in the first place. I was talking through psychology and mindset with one of my classmates. We were talking about capitalism versus socialism and how, on a personal level, you need to make that decision for yourself of what you choose to believe in. And it was my international trade professor and banking professor who told me, you need to write about this stuff. You need to help people learn what's happening here. And you need to help people understand the psychology behind their buying decisions. Everything I've done since that point has solidified that belief. And so we are going to double down on that with this newsletter. Specifically, what I am considering and what I'm planning to do is I am planning to start a budgeting and mindset coaching series as part of this newsletter. I'm not going to promise the moon. I'm just a normal guy, but I'm a normal guy who has pretty much spent all of my free time studying this for the last 3 years. And I want to help each and every person one-on-one who comes to this newsletter to do the same. There will be more details coming out about that now, but here's just some practical ideas that I've learned that I'm going to be sharing with some deviation. I'm not going to give all my secrets away, but some good examples of things that I've learned that can help build or rebuild a money system and rebuild wealth. If I had to do it all over again from scratch with a piece of paper, it's like you and I were sitting across the table in a diner. I have a napkin and a pen. Here's exactly what I would do. First off, you're going to want to separate where the money's going. This is pretty common knowledge, but I'm going to tweak with it a little bit. You want your long-term savings and investment account first. That's where all the money goes first. Whether that's a savings account, high yield savings account, doesn't actually matter. You need a place where money goes and you don't touch it. I tend to keep more money in like a bills and spending account than most people. Most people say 3 months, or sorry, most people say like I think it was a month. I've heard some coaches say. I like keeping kind of a 3-4 split between the two. $4. Yeah, yeah. Though it makes more sense to do more of like a 6 versus 4. So out of every $10, 6 goes in savings, 4 goes into spending. Um, I would have an investment account automated. So I'd have money going into Charles Schwab, Robin. It doesn't matter. Every single month, automatically, I don't touch it. That money is not used for anything else. And then if you're feeling frisky and you have a high risk tolerance like me, maybe a trading account if you're feeling so inclined. But what I would do with that in that case is exactly what I've done now, where the amount of money that I have in my fund money account is nowhere even close to, I don't even think it's 1% of my net worth. It's very small. Um, Another thing that I would do, and I actually recommend people put these into practice if they do not have them. Um, First off, do I know what I'm spending in a month? Do I know where every dollar is coming and going? Nothing in my life has helped me be in a better financial position except one, which I'm not going to tell everyone. I'm going to save that for people who actually want to do the coaching with me because I think that's so profound and powerful. Um, is tracking every dollar and knowing where every dollar is going. And you can use things like Rocket Money, or you can even do something as simple as a spreadsheet in your bank account. And you are brutally honest about where every dollar goes. Um, a next thing that I would do is do a personal audit. You don't have to get complicated with it. You're not a business. You probably don't have a whole bunch of random income streams coming in. But how many months of expenses do I have in a savings account? How many assets do I have? How much money do I have to my name? And how does my debt picture look? We've talked about this over and over and over again on the channel that the number one issue that I've seen in the economy right now is debt. It's really scary to look at the numbers and see things like Gen X on average has a negative net worth. That should be very concerning, frankly. And so I would do that. I would take a look and be honest with an audit saying, where is my money? How much do I have? And if my debts were called tomorrow, could I pay them? Finally, for investing and employment, how concentrated am I? Are you like my buddies who are doing nothing but writing and buying options on NVIDIA? We'll talk about options later. I don't think I've covered them on this newsletter, but we'll talk about it more. We'll break that down and what that means. Am I investing in one stock? Um, what does my employment situation look like? Do I have the time to, I don't know, pick up another income stream? I know that's kind of getting burnt out, but I still think that there's some wisdom there. This is very important. And I don't think most people, at least my age, understand that. Um, Time to my own personal background. Right. I work for a startup. I helped found it. I've been there since day one, and I've been very lucky that we've had income coming in to pay for that. Um, I study private markets or public markets, sorry, pretty in depth. I've I've been lucky enough, both through my schooling and through some other things I've been in on private investment decisions. Um, I think about this a lot. And when I look out in the world, I see a situation where especially my generation and the younger one are not taking their finances very seriously. And that is, aside from who you marry or who you choose to partner and spend your life with, maybe the most important decision you will ever make. Um, these are some of the systems that I want to break down for people. And it's why, after a lot of thought, one, that we're shifting the newsletter back to that, and we're opening these small coaching groups, is so that we can actually go through this. And for people who don't know, we can educate them and move forward about what they should be doing. What we won't be doing, well, actually, first off, I'm going to walk back on that. Here's what we will be doing moving forward with the newsletter. We're going to be diving in more into the world of finance. We're going to be doing more of the 101 articles that I've done on things like macro factors, investing, options, etc. We're going to be looking at sectors deeper. We're going to be looking at financial industries and specific equities deeper to give you an idea of what's happening in those companies. We're going to be talking through case studies and how we can actually be better investors, be better employees, and be better business owners moving forward. I like doing the market briefings and the geopolitical stuff, so we will be talking through those. We'll be doing those every so often as well. And specifically on this live show, we're going to be talking with investors. We're going to be talking with people who are in this, who this is what they do. We're going to be learning from them and some normal people as well, doing smart things with their money. I released a post the other day, and I'm going to do another one looking for more looking for more guests to come on here and talk with you guys. I might even try to wrangle a buddy of mine who is doing some really cool stuff here in Utah to come on and talk with us as well. But that's what you can expect. We're keeping up the cadence right now, so twice a week. I'll try to do better about announcing what we're going to be working on and what you're going to be seeing. This next week, we're going to be talking a lot about the debit industry and why everyone suddenly wants to offer payment services. And we're going to be talking about Bitcoin. Like I said, that article is going to get me into a lot of trouble, but I think it's something that every single person needs to know about. Um, like I said, I'm also going to be exploring this coaching avenue. It's not going to be super salesy and pushy. You're not going to see me pitching the coaching all over the place, because specifically there's a group of people I'm looking for here. I'm looking for the everyday employee who doesn't know what's going on in their finances and would like help. I'm interested in talking to people who are looking to start things. I'm haven't exited on a business, but I'm in the thick of it right now and have been for 2 years. And overall, I'm looking to help people grow their wealth who are currently spinning their wheels. We're gonna have a more formal setup very, very soon. I got to do some more thinking and building on that. And specifically, if that sounds like something you would be interested in, either the newsletter moving forward or the coaching program, shoot me a DM, shoot me a message saying, "Hey, I'm interested in coaching," so I can gauge the demand here for this. Okay, let's recap everything we've talked about today because we're getting close on time. The BDIC chapter is closed. We're going to be moving back towards this newsletter's original purpose. Geopolitical factors matter to us, especially to our investing. Like I've said before, economics doesn't occur in a vacuum. But process beats panic every time. Second or third thing here, mindset and simple systems are going to be guru tips and hype cycles every time. And then finally, this is an evolving newsletter. I have no plan on ever letting this go. It's going to evolve with you to help all of you grow in your financial future and to help me as well. That is all I have to share with people today. Thank you so much, everyone who joined in to listen, like TalkSec, and for people who watch this later. If you are interested in learning more, please subscribe to the newsletter so you don't miss anything. Also, if you could, share this episode with someone who's interested in fixing their mindset on money. and who's interested in listening to, hopefully, at least what I consider, a more balanced and objective take. Also, we're going to do a little mailbag or entrance here. If there are topics that you want covered next, or you're interested in this coaching program I'm starting, send me a DM with details, or you can also email me at wealthandwisdompress@gmail.com and I will get them. Thank you, everyone who watches this, for continuing to support me here. I wouldn't be able to do this if there weren't people waiting. There weren't over 100 people now waiting and listening to this work. Thank you all very much. Have a wonderful Saturday and see you all in the next one.